This is Brad Berry, Chief Investment Officer and Portfolio Manager with Dynamic Wealth Group. Welcome to this Market and Economic Update. In this video, we'll discuss perspectives on the second half of 2025 and why preparing for a range of possible outcomes is key to building a truly diversified portfolio, especially in this climate. The first half of the year has tested investors with trade wars, market corrections, and geopolitical tensions. However, beneath these challenging headlines lies an important factor about investing, which is that uncertainty often creates the very opportunities that can reward patient long-term investors. Over the next few minutes, we'll explore 5 insights that can help to provide perspective in the coming months ahead. Let's start by looking at how markets have performed as we begin the second half of the year. This chart shows the dramatic contrast between the first and second quarter performance, highlighting just how quickly markets can recover when conditions improve. From the market's perspective, recent trade agreements have taken the worst-case scenarios off the table. The round trip from major indices was one of the fastest in history, with the S&P 500 returning to its starting level by mid-May. The key takeaway for investors is that markets attempt to be forward-looking and capable of adapting to changing conditions faster than many can expect. While there's never a guarantee of quick recoveries, focusing on underlying trends rather than daily headlines helps investors stay positioned for when conditions do improve. Next, the escalating Israel-Iran conflict, now involving the United States, has dominated the headlines. The situation is still evolving, but history can teach us some valuable lessons. This chart demonstrates that there is not always a correlation between wars and stock market growth. Namely, there have been periods of strong markets following wars, and there have been prolonged weak markets as well. As this chart illustrates, after 2,500 days, or around 6.5 years, there have been periods when the stock market has been down or has had very weak returns. We'd all love to focus on the green or orange lines and hope that this time will be just like that. However, we do not believe relying 100% on hope is a strong financial plan. As always, we must first acknowledge the serious humanitarian and societal consequences of these conflicts. When it comes to managing our finances, however, a truly diversified portfolio which is positioned for a range of outcomes that is aligned with one's long-term financial goals continues to be the most prudent approach for navigating periods of geopolitical uncertainty. While no one can predict the future, preparation is within your control. What's noteworthy about the current Iran and U.S. conflict is the so far muted response in the oil market. Despite concerns about potential disruption to oil supplies, prices have only increased to where they were a few months ago. This stability suggests markets are taking an optimistic view of the situation. If the future turns out to be not as optimistic, then markets could certainly adjust accordingly, which is why we believe, again, in preparing for a range of outcomes. By having a truly diversified approach, incorporating multiple drivers of returns, not just stocks and bonds. The brightest spot in today's environment is the remarkable resilience of the U.S. economy. This chart shows that most inflation measures are well below 3%. Meanwhile, unemployment remains near historic lows at only 4.2%. While first quarter GDP did contract by only a fraction of a percent, the details show this was largely due to trade disruptions as companies stockpiled imported goods ahead of potential tariffs. So the data could be somewhat misleading. Consumer spending, which is the largest component of the economy, still grew steadily, but again, this could be because of actions taken by consumers to avoid future tariffs by front-loading their purchases. The economy's stability is a crucial component of the stock market's performance during a period of uncertainty like we're currently in. Perhaps the biggest challenge for investors is that U.S. stock market valuations have returned to historically expensive levels, Fortunately, this environment has created compelling opportunities in other areas of the market. This chart demonstrates how international stocks have performed well this year across developed and emerging markets. This pattern serves as an important reminder that market leadership rotates over time. Whether it's U.S. large cap stocks, international stocks, or commodities, it's important to not have a narrow focus in our asset allocations. I would go one step further and emphasize that it's important to also broaden one's asset allocation to incorporate different approaches and techniques. Traditional asset allocation focuses on including different asset classes. However, at Dynamic Wealth Group, we follow a multidimensional approach, including not just a buy and hold traditional asset allocation approach, but also incorporating tactical approaches using quant and fundamental analysis. And we also include alternative investments to help provide non-correlation, or what we like to call different drivers of return. This last chart focuses on perhaps the most important principle of investment success, maintaining a long-term perspective. This chart illustrates how investment returns behave over different time horizons, showing that while annual returns can vary dramatically, they are smoothed out over time. The problem, however, is that as humans, we don't live in the long term. We live in the here and now. We are also driven by both facts and emotions. It's just how we're wired as people. This is why we stress our multidimensional approach. In the one-year example in this chart, you can see that both stocks and bonds can be down rather dramatically over a one-year period. Now, if you relied on those funds to help cover your retirement expenses, for example, or pay for a financial goal, then it would be rather unfortunate timing. This is why maintaining appropriate cash reserves is crucial in a financial plan. Also, equally important is incorporating investments that are non-correlated to both stocks and bonds. And by definition, this is what diversification is all about. Now, I've said this before, so forgive me if you've heard me say this. If you only invest in stocks and bonds, it's like riding a bicycle where the wheel only has two spokes. If one breaks, it'll be a bumpy ride. If both break, you'll crash for sure. But what if that bike wheel had stocks, bonds, arbitrage strategies, global macro strategies, trend following strategies, buffered strategies, etc.? You'd actually have a bicycle wheel with numerous spokes. Or as to connect the analogy, you'd actually have a diversified portfolio and not just the appearance of one. Now, I hope you found these insights helpful. If you are a financial advisor and would like more information on our multidimensional approach towards asset management, feel free to download our eye-opening white paper titled Busting 7 Risk and Return Myths. You can click the link below, visit our website at dynamicwg.com, or email us at info@dynamicwg.com. If you are an individual investor, we are happy to address any questions you may have and put you in touch with a qualified advisor if so desired. Until next time, and I really mean this, take care of yourselves and make smart, logical, and fact-based financial decisions.